You're watching Famous Dave on YouTube.
All right, folks, welcome to the show. We are live, and of course, it wouldn't be a show without some technical difficulties, which, of course, I had going on there for a second. And let's see if we can switch over to our special guest on Skype here, and see if I can actually accomplish that as well. And here we are. It worked. Welcome to the show, Seth Golden. Let me get rid of the second viewing of you. There you go. Welcome to the show, Seth. What's going on, buddy?
Not much. Just watching, and hoping that the market has a little bit more digestion than just these last couple of trading sessions. But, today we had some pretty strong economic data, and we got some key earnings after the market closes. So there's a bit of a snapback here, and, we'll see how it goes. I mean, I like this kind of action. It breeds opportunity. Through volatility, you always get some opportunities, and we've definitely built in some volatility here over the last couple trading sessions.
Well, let's just recap what's happened in the last day or two for people who are probably going to be watching this like at some other time than right now. We had a big spike yesterday based maybe on the coronavirus. We're not sure, but big spike yesterday. And then it looked like the end of the world. And then, surprise, surprise, we come in this morning. Futures are up. VIX is in 2 points or something like that. And we're back sort of in contango again. It was a one-day event, which statistically speaking is kind of what these things are a lot of the time. What was your strategy trading-wise over the last few days?
Well, quick scalps. Yesterday specifically, we had put a limit order in on Facebook, which dropped below 213, tagged our limit order. And this is a trade alert that we send out to our Phenom group subscribers, and tagged it right away in the pre-market. Within 5 minutes, it was up more than $1. So those are kind of the, high risk reward opportunities that we look for when markets gap down. I mean, they're pretty, easy scalp opportunities. Big gaps down, more than 1% on the S&P, more than 1% on the Dow and NASDAQ. You look for, we look for those kind of, trade ideas and execute on them. But just coming into Monday, you don't want to say that or you predicted that this was going to happen, but in our weekly research report, which I believe you get as well, Dave, this is what we predicted. We said we would have more than a 1% drop on the S&P 500 come Monday, and it was predicated on all the research, all the technical analysis, all the market internal work that we had done. Basically starting here in the new year, was saying we could go higher, but once we get to a point where we're like 3 standard deviations above the 200 weekly moving average on the S&P 500, throughout history, we've never been able to stay there. Not ever. So that's, one of those key indicators that you can rely on from a statistical standpoint, and suggest that we were going to have a near-term correction. How deep? You never know that. There's no telling how deep of a correction or a corrective phase we're going to have, but you can, ballpark, within a reasonable, time frame when it's actually going to show up. And so coming into Monday, what I had personally been doing, what we discussed with our Phenom subscribers, was reducing my short volatility exposure. I think I even mentioned it on StockTwits where you and I both, participate, that I was using last week's, continued decline in like UVXY or VXX to reduce my short volatility exposure in preparation, I guess you could say, for a broader market pullback, which would, coincide with a bit of a rise in volatility. And it played out nicely.
So the when I first met you, you were famously in the New York Times, and people were talking about you having been very successful with a short vol strategy. Now your activities have changed a bit since then with the launch of your website and whatnot. Now back then, was it that you were you had several or a couple big backers whose money you were trading, or what was the structure of your setup when you were very successful back then, and how has it changed just briefly over the last couple years, just for people who may not know your story as well as I do?
Yeah, so I guess the New York Times story was 2017, in August of 2017, and it focused just on my short volatility trading as a former manager at Target, and they kind of played up that angle. But I had actually, from 2011 up to that point, I was, a sell side analyst. I was, working for a boutique research firm that, myself and a couple partners started in 2011. And what we would do is we would develop, research reports on specific stocks, if not, the overall market and, economic backdrop, and sell those, as a subscription-based model for the hedge fund industry, commodity trading advisors, and just, other portfolio managers. We did really well with the Capital Ladder Advisory Group business, all the way up and through 2015. We had a pretty substantial, revenue model, and we had some proprietary, software that we had developed for the tracking of sales through the point of sale at retail establishments. And, this one hedge fund that was a client of ours came to us and said, how would you feel about, selling the rights, to that intellectual property and just your overall subscription business. And, we had been, building that business for a good, well, this was in 2015. So we had been building that business for a good almost 5 years. And somebody came along and offered us a pretty substantial return on our, time investment, our actual capital investment into that firm. And we decided, that we would take it. And there was a non-compete clause in there. So that lasted for a good 2 years. But there was nothing that precluded me from running the Golden Capital portfolio, which is a private investor portfolio that I started in 2012 alongside Capital Ladder Advisory Group research firm. And I've been managing that portfolio since 2012 using my primary, investment strategy of shorting volatility. And it just so happened to be that the New York Times reporter was researching it in 2007 because it became extremely crowded, the trade, and extremely popular. And, several things kind of, came together at once, which was the lowest level of the VIX ever hit in history. It hit its lowest level after 25 years in 2017. And the reporter just happened to be, looking on YouTube, searching for keywords, short volley. And he came across my a video that, an interview that I did with David Modell earlier that year. And he reached out to me and, interviewed me over the course of like almost 3 weeks, and, developed the story, and then it, got published. But so far as from that time to now, my strategy really hasn't changed. It's just that we launched a new business, phenomgroup.com, whereby we, help other investors and traders learn how to trade, not just volatility or the volatility complex, but, basically know how to understand the markets, understand the fundamentals, understand the technicals, the macro fundamentals of the economy. And we put that all together in a weekly research report. We have a trading room, a live trading room, Monday through Friday from 8:30 a.m. till 4 o'clock when the bell closes on the East Coast. We talk about everything in the market that's going on. We watch, really good videos to give us a better perspective on what the bears are saying and what the bulls are saying. We watch your videos in the trading room as well, David. And we launched it the day after Christmas in 2017, and we've grown to well over 3,000 members at phenomgroup.com today, and we still trade volatility, but we trade outside of volatility as well. Target shares, Facebook shares, Apple, you name it. It's just about identifying risk reward and knowing the fundamentals of these individual companies and helping guide, these traders and these investors where they would otherwise fall prey to, well, what you see on the media day in and day out. The media loves to, jump on the hype bandwagon. What's the news story of the day that, lends itself cautiously to a cautious or negative narrative. And investors, they see that, and that's all they know. Whereby we do a lot of myth busting at phenomgroup.com and, focus on the facts and historical data. If you don't know the historical data, to a great degree, you're flying blind in this market. So again, that's what we've been doing ever since that New York Times article came out. And I think we've guided, our members really well. Last year, we more than doubled the S&P 500 return. That's how much we outperformed the S&P 500. We issued 244 trade alerts last year to Phenom Group members. 242 of them found their profit objective. And one of them we still have in play, which is Twitter. So if you exonerate Twitter from that equation, we had one loser. And it was small, so no harm, no foul there.
We had a Target open in the mall by my house, and a bunch of my buddies were like, "Oh, maybe I'll apply for Target and stuff like that." And I was like, "Well, I've got a guy. If you do decide to go through with it, I can try to make a call and see if my guy can pull some strings for you over at Target." I was talking with a investment advisor who's managing money for some high net worth individuals, and was very much inspired by your earlier strategies of essentially shorting TVIX and having some sort of core TVIX position on. Now you were sort of espousing. You were going along with that way back then to some extent. Is that something you still would recommend for somebody who was maybe kind of a long-term person who is looking for an alternative to being long the S&P, using like a TVIX to just short the market? I know back then you talked a lot about having most of your cash on the side so that you'd be able to withstand a spike, but then maybe having a long-term short on and, pick your poison, a TVIX, UVXY, VXX.
Right. Yeah. So, the one thing I try to, be conscious of is, or thoughtful with is how I phrase my participation, because, what I've also learned over the years is 9 out of 10 people cannot do what I do simply because of you inherently have to be able to appreciate outsized drawdowns at any, particular time of the year. It's going to happen. And 9 out of 10 people, they just can't, they can't, find themselves, with such, large drawdowns at any point in the year. And for whatever reason, it becomes a very uncomfortable situation. So I don't necessarily recommend anybody doing what I do, but rather learning from what I do and deciding for themselves, what level of short volatility exposure, whether it's TVIX or UVXY or VXX, what level they would be comfortable with owning short long term. Do I think that owning short volatility long term is one of the most, there's no sure thing in the market, but if there was, one thing that lent itself to the closest to a guarantee, it's that these products, these VIX exchange traded products like UVXY and TVIX will decline over time. They will decay in value over time. It's just a matter of how quickly and to what degree while you own them short. And the only way you can really own them short long term is by limiting your exposure. In the past, and this is always also a dynamic of the short volatility core holding paradigm. It's dependent on the macro environment, and the macro environment always changes. Therefore, your short core holding will have to be modified as the macro picture, the macro fundamentals change over time as well. So I don't necessarily recommend it outside of, doing it alongside a professional or somebody that's experienced, like yourself, like myself, like Vance, Hardwood, the Invest in Vol crew. You don't necessarily want to do this on your own because, again, there is going to be a spike like yesterday in VIX, in the VIX futures, and in the price of these instruments. And a lot of people just, they get inside their own heads. They let the headlines of the day, the coronavirus, the FOMC meeting tomorrow, the yield curve starting to flatten out again. They watch these videos that proliferate on YouTube or in social media by Sven Heinrich or David Rosenberg and Danielle DiMartino, and they think that's the reality. These folks that have been wrong for the last 10 years are all of a sudden right because recency bias in my instrument going against me, and then all of a sudden they make these decisions, or they that are detrimental to their portfolio. So if you're going to do it, I simply recommend being coached and mentored by an experienced person who has shorted volatility for some time.
Yeah, it seems like that's good advice. You kind of really have to have a, you have to buy in and have conviction into what you're doing. And it sounds all great when it's going your way, but when you really need to have that conviction is when the stuff is going against you,
right, to
not cover at the top. Because and I know in my own trading, I've known it. You have, let's just use $10,000 for a small account. You have $10,000 at risk, and you don't really want to risk all $10,000. You want to risk 1,000 of that 10,000. You say you want to risk 10,000, but when it goes against you by 2,000, all of a sudden you want to throw in the towel and give up. And you have to know yourself. And if you really feel comfortable that, like, yes, I understand that this is what the risk is, and I'm going to have to maintain my conviction against, because like you referred to, it's very difficult when you go into like the StockTwits chat room and every single person is saying this is the end of the world and the crash has come. It's very difficult to maintain your your own internal convictions when everybody else is telling you something else. And it's something that I think people have to develop over a period of time, really. And it's about knowing yourself. And I know it sounds cheesy when you tell people that you have to know yourself to be an effective trader, but it really,
in volatility, more so than any other complex of the market. I think in volatility, you're exactly right, David. You have to know your inner monologue has to speak over the litany on StockTwits, the litany of, media headlines and whatnot. Your inner monologue has to be, pretty strong. And the only way it can get there is if you develop it over time. I go on StockTwits and I see these nonsensical comments and what have you. And, people, and then there are some smart people on StockTwits, yourself and other people that have been there a while, but they kind of get overpowered by, the multitude of, nonsensical comments and people actually saying, why are you on StockTwits if you're looking for help? You don't go to StockTwits or you don't go to Twitter. When in fact, there are, people that, like myself who participate there, because I've seen people get hurt doing this on their own. I saw people get hurt during, Volmageddon. And I saw people get hurt in 2015. We had a really substantial spike in volatility that lasted a few months. And that kind of, because it's, a whole 5 years ago, people forget about that situation. They only focus on Volmageddon because it seems, because it resulted in the accelerated termination of a product, XIV. But those, the few that are on StockTwits that can really help guide folks and help them learn how to trade volatility, they kind of get overpowered by the nonsense that goes on there. So for sure, you have to have, conviction, as you said, and discipline. It takes a while to develop discipline. But that's why, I think mentorships, coaching, and sites like, mine and YouTube channels like yours are a great benefit to, the volatility community.
Well, let's talk macro for a second.
Yep.
We're coming into earnings. We've had a great run over the last year. If we look at the S&P chart, we're still in a huge rally long term. We've got elections coming up eventually. Where are we, and what should we look for from this particular earnings cycle to give us some clues as to what the market's gonna do moving forward?
Yeah, so the Q4 earnings cycle right now / Q1 Apple, right? Because that's coming after the closing bell today. They're actually reporting their fiscal Q1, but everybody else, for the most part, is reporting Q4. I am expecting, once some of these mega cap names, like Microsoft tomorrow and Amazon, this week as well, some of these really big mega cap tech names, I think they're going to have some nice beats. So that's going to, lend itself favorably to the Q4 EPS blended rate of growth here. And I think we're going to see, revisions to the upside in the forecast for Q4 earnings. For 2020, we're looking at, if you go by like FactSet or Refinitiv, they're both calling for 9.5% earnings growth in 2020. I actually, and I wrote this in our recent research report, I think they're light. The main reasons I think they're light is because we have more tailwinds here this year than we did last year. We also have easier comps entering the Q1 period. I think a lot of folks forget consumer spending was still muddled in the first quarter of 2019 because we were still dealing with the longest government shutdown in history. So Q1's consumer spending, I think we're going to lap an easy comp. And that sets us up, really well for pretty much, the whole of the year, just looking at the earnings picture. So from that perspective, I think right now the 9.5% earnings growth rate that's being forecasted for this year could wind up being light. I think that's also one of the reasons why the market has continued, 3,100, 3,200, 3,300, 33, 37, 77. It just kept melting higher because I think it's sniffing out that earnings forecast for this year expected to rebound by pretty much everybody upwards of 9.5. I think the market is sniffing out that might be light. We have some of the other tailwinds that we have are the price of crude. It's come down recently, because of this situation with the coronavirus epidemic. It's not a pandemic yet, and there's there's a distinction between epidemic and pandemic. It's not on the pandemic level yet, but we're seeing crude drop off some greater than 10% in the last week and a half, simply because of this. But that only puts us right to where we were last year this time. So if we're just flat on crude, that bodes well for the energy patch and those sectors' earnings. And then we've got the dollar, which is basically flat at this point on a year-over-year basis, and it's all going to come down to demand. The earnings picture is not going to be any lesser impacted by corporate buybacks this year than it was last year. You still have that tailwind, and we've removed one of the biggest headwinds that has been, in the economy for the last 18 months, which is the trade war. I get that we haven't removed all tariffs. But if you look at it from a tailwind perspective and on a year-over-year basis, we've removed a good, portion of those.
So there was a question from the chat when you were just talking a minute ago. You were saying you're using the term easy comp.
Right.
What does that mean?
So in terms of retail sales, consumer spending, the first quarter was rather light last year, 2019.
And a lot to the government shutdown you were talking about. I remember that because I'm filing my taxes now, and before it was like we were thinking taxes would be delayed last year because the government shutdown. But so easy comp. What is that? What does comp mean?
That lends itself to we should see more consumer spending in the first quarter this year than we did last year. Okay. And that's going to lend itself positively to first quarter sales and earnings. The only headwind there for the broader economy, which really doesn't play into the earnings picture, is the situation with Boeing and basically a lack of productivity coming from, the building of the 737 MAX airplanes. But that's more from a macro standpoint, that doesn't bleed into the earnings picture. The consumer is the biggest part of this, economy at 70%. It's 70% of GDP comes from consumer spending. Only, right around 10, maybe 11% of economic growth comes from manufacturing, and that which lends itself to, the productivity from Boeing and, of course, crude oil and things like that. But really, it comes down to the easy comps in the first quarter from consumer spending. The headwind that happened last year was the government shutdown, and basically people still just kind of being very impacted in real estate. I mean, if you go back to the first quarter of 2019, the New York City real estate market was in disarray because the stock market was in disarray in the fourth quarter of 2018. So that still had some impact on Q1 2019. All of that was still, lend itself to easy comps, in 2019 for where we are today. So that's why I think the earnings, that's why I think the market has continued to trend higher. It's like, they see the easy comps. They see that, retail sales in January were They see that February retail sales were starting to spring back. But now we're in this point right now where if you look at Gallup polls, the average consumer thinks that they've pushed the issue of a recession way off their radar. That's in the latest Gallup poll. You saw the consumer sentiment data this morning, the consumer confidence data this morning is basically back at, almost at its record high at 131. That data came out this morning. Both the durable goods orders and the consumer confidence index came out this morning, and we saw what happened after those data points came out. The futures just kept rocking, and then when the market opened, we get the consumer confidence data, and we soared to intraday highs. And the bond market confirmed it too. The bond market started to sell off. We saw yields push higher. And I know that sounds kind of counterintuitive. Why do we want rates to go up? Well, we want rates stable. We don't want them in the 150. We don't want the 10-year yield in the 150s or lower. And we pressed upon 159 yesterday in the 10-year. So getting it back to 165 today with the market moving higher is confirming that, today's snapback is, could possibly hold. And then we see what the earnings, what Apple and Starbucks and Xilinx say after the closing bell.
So let me throw a couple names at you real quick that I'm interested in. Tesla, Beyond Meat.
Go ahead. I'm sorry.
Tesla, Beyond Meat, Carvana. Some of these companies, if you look at them individually, just seem very, very elevated, regardless of the economic indicators. What do you make of specifically? I know a lot of people are interested in Tesla and trading. What do you make of all that? Is it just a popularity contest, or are people getting squeezed?
Yeah, there's definitely, you had a really substantial short squeeze, and you can lump Beyond Meat into the same equation with Tesla. They literally, if you pull up the two charts of them together, were running in tandem. Now, here's my fundamental take on Tesla, and I'll preface it with what moves Tesla stock: belief. Tesla doesn't move on fundamentals. It doesn't move on technicals. It moves on the size of the float and belief in the business long term based on the technology. From a fundamental standpoint, though, Tesla doesn't exist post the financial crisis era. There's no possible way that Tesla would have made it through the financial crisis based on their debt load, based on the lack of free cash flow, based on any discounted, free cash flow model. You could go out 3 years, 5 years. Tesla can't sustain this. So Tesla, in my opinion, is the likeness of a Ponzi scheme, because what the true believers are forced to believe is eventually Tesla can scale the business to the point where they can reduce cost, the price point on a vehicle. Because if you look at the total addressable market for Tesla at its existing price, its price structure per car, it's an impossibility. There's no possible way, because the total addressable market is just too finite. I mean, if you look at companies like BMW and you look at Mercedes, they're lucky to sell 2 million cars. I mean, obviously Tesla's nowhere close to that, but that's the addressable market. Your addressable market is based on your price point, not based on what it is. It's a car. That doesn't mean that my total addressable market is, the per capita, of the United States, the population. It's about the price point that can afford that car. The technology itself forces the company to, introduce these products at the very low end. It says the $50,000 range, but you really can't get a Tesla with what you're buying it for $50,000 at the low end. You're upwards of 65 if you want some of the bells and whistles. But most of them are, in the 80 to over $100,000 range. That market is very, very small, and you're competing with all of the other manufacturers. So the belief is that if they can scale it, they can reduce the price. The problem is it's the cat chasing its tail. The total addressable market says you can never scale this to the point where you can actually reduce the cost per car. So what is Tesla always forced to do? They're always forced to go to the debt market. They have every now and then these quarters where all of a sudden they produce a profit, but it's fleeting. It has to do more with, the things that they're doing behind the scenes more than the things that are normal operations. It's not that I hate Tesla. It's not that I dislike the car. It's phenomenal.
Nobody. Well, the thing is that it's not, your insight. I agree with, but I just want to caution people that it's not a really tradable insight, in that if you go in there and start to short this thing, you're going to get run over, It's
100%. That's why I've always said, people always ask me, then why don't you short it? Well, I don't short it because I have to deal with belief.
Right.
What I know from a fundamental standpoint, and having been a sell-side analyst and analyzing very different business models over the last 10, 15 years, is this is not sustainable. This business model is not sustainable. However, as an investor or a trader, I know I can't trade this thing because there is a belief, system out there. There is a contingency of investors that are not selling their shares. Not now, not likely ever. until the finality is realized. And that finality is either they're going to disprove, history, because that's what they would have to do. They would have to disprove history of total, addressable market analysis, or, they do find themselves in bankruptcy when we're in some kind of significant recession and they can't go to the debt market and, find financing. One thing or the other. So I stay away from it. I don't trade Tesla. I just don't trade.
I don't either. And I think part of the reason some people may buy the stock is that they just have this belief that maybe Elon Musk will come up with something that we don't know yet that is new, that will somehow change the whole dynamic, and so it's a buying in on Elon Musk is what it is. Right. When people buy that, and people think, well, I don't know, but he's gonna maybe, it's kind of like that Steve Jobs thing around him, where like, maybe he'll come up with a spaceship car and we'll all fly to Mars with it or something. And it's that excitement that is around the company that just it keeps it going. But it brings us to kind of a something that dawns on you if you've trading for a little while, which is that somebody like you who's really good with analyzing companies and the numbers can do that, but that's not the end picture as a trader for the market. There's you can analyze all the numbers you want, but then there are many stocks that just are in their own stratosphere. Right. And recognizing that keeps you alive as a trader, it seems.
Yeah. Beyond Meat, you had mentioned Beyond Meat, and we've been shorting Beyond Meat with our members, all this year. I think we've got like 9 shorts that we've completed in Beyond Meat, but that's a unique situation. It's like all of the perfect, all the ducks lined up perfectly in a row for Beyond Meat as an IPO. It became, there's always one out of a batch of IPOs every single year. There's always one that for whatever reasons, all the ducks line up perfectly to give it this just tremendous valuation.
Yeah, it got up over 200 at one point.
Oh my gosh, it was ridiculous. And even the valuation here at 120 is something like almost $6 billion market cap is stupid. It's just stupid.
Well, it's a competitive market, that food market, and it's not like they have something that other people can't repeat.
Right. There's no moat around that business. And, people will complain all day. Yeah, there's not moats around a lot of business, but really, it comes down to the business model. And what happens in these business models is no different in the Beyond Meat business model is no different than any other consumer packaged good product. As in their infancies, and as they, come to market during these accelerated growth periods, they come to the market because they need financing, because they need to get to the next level of their business, which is, nationwide distribution, if not international distribution. And they need the funding to, broaden that distribution. But here's the thing with all of these CPG companies, you go through this hyper growth phase where you continue to expand your distribution. You're going into this restaurant, or you're going into this grocery chain and that grocery chain and that hypermarket and this region of the United States, this region of North America. Well, as you saturate the business, as you saturate the distribution chain, you're left with one thing. You were initially selling in cartons into this grocer, cartons into this distributor, and cartons into this one. Those cartons eventually have to be, the packages get taken out of the cartons, they get put onto a shelf, onto a freezer, whatever, inside the actual retailer. And now it's got to sell to the consumer. I can send you a carton worth 10 packages in it. Those are big orders, big numbers. That's where all the major growth comes from. That's very quick. It's a lot of revenue. It's a lot of profit margin. the hardest part of that CPG business is once it's sitting on the shelf and the consumer takes it off the shelf, that's much slower.
Get that second order in, that third order in.
Exactly.
That's when it really happens. Yeah.
Right. So the orders start to slow and slow and slow. And when the orders start slowing as a publicly traded company, you're forced to do what you otherwise wouldn't have to do if you were a private company, if you stayed private, which is you have to raise your advertising and promotional spending, your marketing spending, because you've got to sell more. You have to do whatever you can to get this in front of the consumer's face and in the consumer's hand.
It kind of reminds me of like e-cigarettes. You
Mm-hmm.
know, when it first came out, everybody, it seemed like, well, not everybody, but smokers, everybody tried them, you know, and it was like a big thing for a little bit. Everybody tried it, but then, you know, 80% of the smokers kind of went back to smoking. And, you know, you got some people that were really into it. But, and, you know, I saw Beyond Meat in my local Dunkin' Donuts. So it's definitely better than like a biotech company, investing in a biotech company where like, it depends on the valuation, of course, but they do have a product. They are selling something and they do have a customer. So, but a lot of times people, I think when they trade or invest in companies, they may like the idea of the company, but they miss the step of saying, well, is the valuation correct? They just say, okay, well, it's a good company, so I'm going to buy the stock. Well, is the stock expensive? Is it cheap? That step of like trying to evaluate the price of the stock and is it priced right is the whole thing, but that's a step that a lot of people or at least investors kind of miss out on, you know?
Right. And imagine if you had bought Beyond Meat on the way down from $230, $240, and you said, oh, it's $200. It's all over the news. It's all over CNBC. The analysts are raising price targets. You know, imagine if you thought $200 were cheap and now you're sitting here at, you know, $120. You know, you're feeling pretty rough because you don't know all the nuances behind the business model and how these business models tend to play out. You know, these business models, they all play out the same way. And, you know, for kind of a, you know, we can kind of look at other IPOs in the past, which are not necessarily food, consumer packaged goods, but gadgets. They're the same thing. They're all in the consumer packaged goods category. Even if it's a gadget, it's not a consumable. GoPro,
Fitbit, yeah.
Those are still consumer packaged goods, even though they're, you know, in the gadget category. It's the same business model. They go public to get funding so that they can broaden their distribution model in North America, if not internationally. But the problem is that's where all the money is made. That's where all the profits are. That's where all the accelerated revenues come from. But once you've saturated the distribution network, you're still left with trying to sell it to the customer. And it's just a slow moving process from that point until eventually you're left with a real, you know, supply demand equation that has, you know, certifiable profits, you know, if there are profits. Fitbit hasn't been profitable for the last 2 years. GoPro, same situation. These one product, you know, one trick pony companies are really bad business models to invest in, based on my experience.
And that was those two examples were easy ones for me to pass over when it came to the market, because I kind of got that dynamic of like, well, this technology is exciting, but other people are going to come in. It's the same kind of thing with Beyond Meat. Those ones are easy for me to pass over. I want to just steer back to volatility for a second. I got a question from the chat regarding like when we're in a spike like yesterday, what kind of clues can we use to decide when we want to kind of jump on that short train? Do you have anything that you like specifically kind of look at, or is it just, because for me it's just I try to back way away from it and just say, okay, it's up a lot today, I'm gonna get short a little bit somewhere, and it's very general. For you, is it some specific thing where you say, oh, you can see like, oh, the market's turned, it's time to jump on the short train?
I don't tend to, because that's more of a timing, like somebody's trying to, time when, we're using the, the verbiage when.
Right.
My strategy doesn't consider when. It simply considers duration. It doesn't matter what price I jump in. As long as I give myself duration, which is, the same as saying liquidity, in your portfolio, it just doesn't matter when I jump in. Naturally, we always want to get that best price. But, the example from yesterday. So yesterday, VIX was up 25%. UVXY jumped, it closed the day at 13.55. It was up more than a buck and a half, if you will. I waited for the aftermarket. Why? Because, well, the move has already happened, and you got less volume in the aftermarket. You can see where the VIX settles out as well, and you can see what futures are doing. And futures started to rise in the after hours. We got Whirlpool's earnings. So from that standpoint, we had more information to go on. We've already lost 2.5% on the S&P, and the VIX was closed above 18. Just looking at those levels and how the definition of the market played out that day, I decided to put a trade alert out in the after hours for our Phenom Group members at $13.50. If it didn't come in the next day, which is today, that's fine. It's a small position. We can build at higher levels if the market dictates that we need to do so. The only way you can do so through is based on your positioning and how much duration or liquidity you're giving into your account. So that's how we go about it. Most of our scalps that we do or positions that we enter are no more than 2%, upwards at the top 3%. But in order to do like a 3% exposure for a scalp trade, all of our market fundamentals and technicals have to line up pretty well, as they did in the fourth quarter last year. We increased our exposure for each scalp at the tail end of last year, just trying to, really boost our returns for the year, because everything was perfectly aligned in December of last year to do so. Right now, it's not the same case. But the best way I can explain it is your exposure, how big of a size position you're deciding to try and scalp or trying to enter a short volatility trade is basically going to determine your ultimate outcome in the trade. It will eventually find a profit. But if you're doing trying to put 10% of your money into a short, scalp that day, you're gambling, and you're really not doing it in a very disciplined manner. So,
I had some interaction with that gentleman Wayne Nelson, who's been is he
Yes.
with you guys now? He's a really cool guy.
He's
Really
the partner
cool.
of Phenom Group now. He does our options, mastermind options trading room. Every day, Monday through Friday. That's another service that we provide to help, folks learn how to trade options, doing strangles, straddles, all different kinds of iron condors and whatnot. But yeah, he's become adept at trading volatility.
Yeah, really nice guy. Definitely. So what? It sounds kind of like you're still pretty kind of bullish this market right now. What could potentially spear this? Like what's the black swan that can happen here that can really make us come flying down? Obviously, a black swan by definition, we don't know exactly what it's going to be, but what could make this market go south? Because I mean, do you still believe that we are in some sort of boom bust cycle where we are going to see a day will come when we're going to get a big down move? And what could bring that to us?
Yeah. So, I think we're always in a boom bust cycle, regardless of what these folks say. These popularized and famous hedge fund managers. I think we're always going to be prone to the credit cycle. That's what it comes down to. As long as credit is free flowing, there's no seizure in the credit markets. The economy tends to just chug along. It doesn't, we may not be at trend growth or above trend growth. You may have below trend growth, but it's still not a recession as long as credit is free flowing. If there's something that should cause a seizure in the credit markets, then you're going to have a recession. So far as what could cause that, a lot has changed since the great financial crisis that I don't think a lot of investors appreciate or respect. And we can poke fun at the perma bears all they want for their hatred of the Fed, because that seems to be where the root of their dismay over this now 11-year bull market comes from. But the reality is it's much bigger than that. There's been a demographic shift and a technology shift since that time that makes it increasingly difficult for us to find a recession. And if we're not in a recession, usually the worst thing that can happen to a market is a technical bear market, which is what we had in Q4 of 2018. So why do I say that? Because when you look at what the consumer has done since the great financial crisis, they've done a complete 180. Is that or 360? I don't. But they've done a 360.
180. Yeah, 180. 360. Okay. They'd be going back the same way. Yeah, I think 180 was right. You're right.
I'm smart, but I'm not that smart, I guess.
I think it's 180.
So if you look at household obligations as a percentage of disposable income, we are at the best level since the 1970s. I said this through much of 2019, and why we rode the bull market. Never took down our exposure. Never. Not during May when the market corrected 7+%, not during August, and not that hiccup in the first week of December. We never took down our exposure. We only increased our exposure. And the reason is because of that metric. It's the most important metric there is for this economy, which is dominated by consumer spending. So if we go back to the last crisis, the last recession, disposable income as a percentage of household obligations was completely out of whack. Essentially, the consumer didn't have a dime to spend. Their debt burden was so high, as opposed to, what they could actually service that debt, how they could actually service that debt.
Wages were very stagnant too. Yeah.
Yeah. They just kept building their credit, any which way they could. And then all of a sudden you get a crisis and it teaches you a pretty profound lesson. So the two things that have happened as a benefit from, the last crisis is when we look at that chart now, it's at its best levels. The consumer still has more debt today than they did, in 2007, but they can service it at a much better rate because they've had a good 10 years worth of deleveraging opportunity, as well as wages rising over the longest expansion cycle in history. You allow those things to take place, you've essentially made it that much more difficult to go into a recession. And the other aspect is technology. Technology does nothing but, basically put a limit on inflation. We can't get inflation in this country to save our lives because of the information technology era. When it was popularized, smartphones became popularized. We essentially now have the best tool in our hands to combat inflation. Anything we want, anything we choose to spend money on, we can essentially find the best price through our mobile device. We have the pricing power. The retailers don't have the pricing power anymore. And that's another reason why the consumer's balance sheet is in such good shape. They're no longer spending $10 for this shirt, they're spending $8. It's called price transparency. It sucks for the retailers, but again,
it's efficiency for the market. Yeah, definitely. Somebody asked a question from the chat. Well, I'm kind of summarizing it, but is the Fed propping up this market? Is this market only rallying because of all of this repo overnight and whatnot. Is the Fed behind the scenes here doing some crazy stuff?
Yeah. So again, I follow the Danielle DiMartinos of the world, the Rosenbergs of the world, the Sven Heinrichs of the world, because they have a big mouth, and they're the squeaky wheel, so they get the most attention. But B, because I want to stay, I want to stay attuned if there's any information that is contrary to my understanding of how the Fed operations work and how they influence, to whatever degree they influence, the bond market or the equity market. And there's it's commonplace now. It's become, in fashion or in vogue to suggest that the Fed's repo market activity, or just their balance sheet, right? Expanding the balance sheet somehow inflates equity market prices. The reality is it doesn't hurt equity market prices. But at the same time, it's not the reason why equity or risk assets inflate. That's not the reason. Remember, the Fed was actually contracting its balance sheet almost all last year. Up until September, they finally ended the balance sheet contraction. What did the market do? It went up all through that time period. So we can't necessarily say that just because the Fed is doing anything on their balance sheet, the equity market is going up. There's obviously a contradiction there that disproves the theory that when the Fed is doing this, that's the reason why the equity market is going up. So I repeat, it doesn't hurt the equity market that the Fed is expanding its balance sheet, but it is not the reason the market goes higher. The Fed can only do, there's no switch. There's no button that all of a sudden when the Fed, buys, shorter dated or long dated maturities, all of a sudden equity prices go up. There's no button, there's no switch that all of a sudden brings about increased liquidity in the equity market. Because that's the other thing that I think a lot of investors and traders don't realize when they hear these comments about, the Fed boosting liquidity. The Fed doesn't boost equity market liquidity. It simply provides sentiment. If the Fed is expanding its balance sheet, it provides sentiment to commodity trading advisors, hedge funds, and that community of institutional investors. It provides them with the sentiment that the Fed is there. The Fed is there to backstop the economy and risk assets if things should go awry. Therefore, I feel better about going out on the risk curve and buying the spiders, whatever, risk asset, whatever equity. I feel better. So the only thing that the Fed does through basically providing liquidity within the bond market is boost sentiment or appetite for risk assets. And that's also why you don't hear the perma bears specify where the liquidity is being, increased. They don't say equity market liquidity is increased. They just say liquidity is being provided to the markets, because they know it's really just bond market. It's not equity market. The only thing you're getting in the equity market is sentiment.
Yeah, and repo activity is really just kind of like lubricating stuff overnight. It's not. It's
Right,
getting paid back right away.
It's a way to ensure that we don't have, all of a sudden a seizure in the credit market.
Right. Yeah. Exactly. So we've talked about this before, but so moving forward, do you give credit to the president because for me, I give some credit to the administration for providing a stable place for us to work our magic. The United States stock market is a stable place for us to play our games, and I give some credit to the administration. If an Elizabeth Warren or a or a Bernie Sanders comes into office, is the stock market going to crash? Is it going to be the end of our chances in the world? And do you think that the market is going to react heavily to political stuff moving in the next while? I know that over the last while, there was a period where like every tweet moved the market, and we kind of seem to have moved away from that a little bit now. But how do you feel about politics in the market in the next while?
Yeah, you definitely have to, that has to play a role in your overall portfolio management. You have to bake that in, to your macro outlook. The way that we talked about this in our weekly research report, we see, three things coming together, that could provide the market with a bit of a corrective phase. One was the coronavirus headlines. Two was, the Fed curtailing their bond purchases. And the third one is the Iowa primaries on February 3rd. So all of this together gave the market kind of the perfect excuse to, work off some of these frothy conditions, these overextended conditions and what have you. I do think that, if a progressive candidate does, win the Iowa primary, the market will have an adverse reaction simply because the likes of Bernie Sanders or Elizabeth Warren have a more progressive stance when it comes to the tax policy, and the market doesn't really want the apple cart to be upset. I think it would be short-lived. I don't think it'll be, market crash, not for the primary, because we still have a ways to go, until the November actual election. But the market could have a hiccup here if, one of those two candidates win. So far as the president, Donald Trump is concerned, I'm of the opinion, I said this back in October through November, at kind of the height of the trade war, threatening the December tariffs, which really, really would have hurt everybody, in my opinion. We started noticing that Larry Kudlow was becoming an increasingly important person, playing a role in the whole discussion of the December tariffs. Mm-hmm. And I had said then, as I noticed, he was being moved to the forefront. Peter Navarro and Lighthizer were kind of being pushed back from the spotlight. Larry Kudlow knows what it's going to take to get the president reelected. And that's all that matters. That's all that matters. As an investor, as a trader, that's all you care about. In terms of upsetting the apple cart for the market. Regardless of what you think of the president, his personal, this, that, and the other. I kind of I leave those biases on the sidelines. As I, manage the Golden Capital portfolio, I have to, present myself with facts and analysis of those facts. And I come to the understanding that Larry Kudlow is steering the ship. He's been steering the ship, heading into those December tariffs, and it worked out well. We didn't put the tariffs on. We got a phase one trade deal. Larry Kudlow knows what it's going to take to get the president reelected. He knew if those tariffs went into place, it would demonstratively hurt our economy from a consumer sentiment and then eventually spending standpoint. We could have been looking at the same situation as 2018 in the fourth quarter. He made sure that didn't happen. We were never going to get this grand deal. Really it couldn't play well with China. So we get a phase one trade deal, and now Larry is on to the next phase, a possible phase two maybe later in the year, but primarily focused on getting Donald Trump reelected. So as long as he's steering the ship there, I feel, more confident about this market and about the economy. I mean, now we're talking about a possible, tax policy for the middle class. Does it have any chance of passing? Probably not. But the majority of the market doesn't care about passing it. They care about if it's going to be moved forward. And that in and of itself, just that dialogue itself will play well for the Republican Party through this election cycle. Why? Because you're not, the Democrats are less likely to take, the executive branch if they, dismiss the possibility of another, tax plan that benefits the middle class. So I know that Larry Kudlow knows this, that which I'm talking about. I know he knows this inherently, and that's why I feel confident about this bull market in 2020.
Yeah, I tend to think that the president, this election is the president's to lose. I really feel like he's got it in the bag at this point, and
it's really hard to lose an election with the market at all-time highs and in a expansion cycle. It's rare.
And I've come out many times as a lefty, of course, but I don't, for you and I know that talking partisan politics does not help build a customer base, because people are very strong in their opinions.
Right.
And from either side of the aisle, half the country can't be wrong. We're all, Americans here or whatever. But as you point out, we're here to make money and to help other people make money, and thus that is our the point of view where we're coming from and trying to figure this stuff out. And I know that politics, like predicting what the market's going to do based on who wins an election, has always been a losing proposition, so I don't even try too much. But I tend to agree with your viewpoint that as long as the status quo kind of continues the way it is, that's the most comfortable thing for the market right now. It seems like. Right.
The market more, the market likes certainty, and to the degree it can, have some, stability / certainty here in 2020, the market should trend higher. That's not to say it'll go up in a straight line, but we should have higher prices in the back half of the year than even what we have right now, in my opinion.
Edward from the chat says, "I'm not American." It's okay, Edward. Canadians are okay too. We're not talking about exactly, who's American and who's not. I realize there's more than American viewers here, and much appreciate your input into the chat here. So I apologize, Seth, that I haven't been more active on your site. It's a busy life for me, and I try to get on there more.
No worries.
I'll try to get on there more.
No worries.
I apologize. Moving forward, it's hard, and I do want to get. Are you still in Florida?
Yep. Still Ocala, Florida. I've been doing a little bit of travel lately because I do some consulting work as well for hedge funds and the CPG category. I still do consulting for startups in the consumer packaged goods industry. So
somebody says on
New
there,
York, Chicago, and
oh, nice. Yeah, somebody says, what TV shows does Seth watch recommend?
I like The Big Bang Theory.
Nice.
That's one of my favorites. My wife likens me to Sheldon Cooper because I'll say stuff not realizing that it's too frank and to the point and whatnot. And I'm kind of a deliberate person. Don't tend to beat around the bush, and I see things through a weird prism maybe. But I like Big Bang Theory, and don't take my man card away from me, guys. Yes, I watch The Bachelor. So
so like some of that reality stuff, huh?
Yeah, I mean, those are my two shows in sports. I like to watch sports, basketball, whatever, the season it is. We're in basketball season now. My favorite team is the Boston Celtics. In baseball season, it's the New York Yankees. Football season, it's the Denver Broncos. So I'm always watching sports, but I have two toddlers, so TV isn't necessarily, I don't spend a lot of time unless it's at night and it's on ESPN. I can catch a game.
Well, it looks like we have quite an international audience here of people from different areas. There's another question here. It says, why is there bad blood between Seth and other volatility trader on Twitter? And just to refresh people's memory, there's bad blood between Seth and a lot of people. He's
Yeah.
I'm not quite sure which one he's referring to.
So like I said, I don't always come across well. And, people were first introduced to me as the ex-target manager, not realizing that, a story in the New York Times is already pointed in one direction. And, the author, the reporter wanted it to come across as this this good story of, this lowly target manager turning, a few $100,000 into several $1,000,000. And the best part of my days, and it still is, spending time with my kids. But they don't realize, I have two degrees and, another one kind of, but I didn't finish because I met my wife. I have my first degree is in English education, teaching high school. Then I got my law degree. And then I went to get my registered nursing degree. But, I got to my practicals, and that's when I met my wife. And I decided that's what my focus is. I took, tons of courses in finance and economics. I read everything I can get my hands on. I've been a member of Mensa since I was 13 years old. And so, I guess, my communication skills aren't perfect, and I can come across maybe too verbose or too assertive, and people don't like that. But I'm also very adept at, calling people out as well for their peddling, as I call it. And I don't like narratives that are peddling what I call garbage, and they're just wrong. So, a lot of folks in the Twitter sphere and whatnot just don't, appreciate that. I find errors. I'll try to ask about it, to the author or to the promoter of this tweet or that tweet. But it's Twitter. People are about ego on Twitter more so than they're about, the information itself being valid. It's about the ego. StockTwits, kind of the same thing. People don't like to be called out. People don't like to be quote unquote wrong, and to the degree that you can be anonymous on Twitter, it's just easier to lash out than accept either better information or tutelage or, some level of education. It's just easier to, be the big dog than it is to accept that, well, somebody else might have, a little bit better perspective on this subject matter or that subject matter.
Well, StockTwits is hilarious. There's one guy, which I'm sure, I'm pretty sure you're familiar with, who's always calling people out on StockTwits. This is hilarious. His name is like Old Effin' Guy or something like that. Have you seen that guy?
A long time ago.
He just he just burns people left. I've been working to try to get him on here sometime because he just burns people left and right, and it's hilarious. And there's something of that in all of us to come. It's so much easier to come on to social media, and I find myself doing it myself sometimes. On non-trading subjects or something where it's so much easier to say something negative and try to chop someone down than it is to actually contribute to a conversation. Because when you're not, for you and I, this is like our business. But when you're on some other subject that maybe you're not an expert in or it's not your business, it's so easy just to come in and make a snide comment. And It's something not to take seriously for us because you'll pull your hair out if you take it too seriously, I think.
Yeah, for sure. I mean, I try to approach information that's shared either on StockTwits or Twitter with the grain of salt. But for phenomgroup.com, I find a lot of really good stuff on Twitter that is just wrong or being promoted with a bias. It's usually from the perma-bear community. They like to, change the fractals on their charts, or they like to put really nonsensical economic data and correlate it, with something else that it would never otherwise be correlated with, that, lends itself to a market crash, coming soon. That's the kind of stuff that I do actually seek out on Twitter. There's this one guy, Not Real Jim Cramer. He's notorious for putting out these charts that correlate different economic metrics that point to a possible recession, but only because they've they shouldn't be correlated. And so we find those kind of charts, and he blocked me recently because he knows what he's doing. This
It's
Twitter account.
Yeah, it's confirmation bias. You can always find a chart that'll back you up on whatever you want to do in the trading world. And I know it's frustrating for viewers that we don't all get along in the VIX complex all the time, but this is just the reality of traders. Traders are alpha people, and we're not going to all get along no matter what. And in a way, it would be better if we were all buddies, but we're going to disagree not just personality wise, but we're going to disagree on the way we see the market. We're going to disagree on what's the volatility and what drives what. And for me, the viewer's take should be, take what you can from each person. And just accept that we're not all going to get along and be buddy all the time. It's just the way it is. And the trading world, more than other worlds, is a world of alpha. In a sense, you have to be aggressive. You have to have conviction, and you have to believe that you're right and other people are wrong to execute and be a successful trader. And it goes along with the territory, I think.
Yeah, no, I agree. Some of the volatility traders and authors, for the products and whatnot that I respect and get along with pretty well are the folks from sixfigureinvesting.com, Vance Hardwood. I've had a good relationship with him for a number of years now. Mike and Matt from Thompson Capital Management, like those guys, they're pretty even keeled. It's not an egotistical situation amongst those group of volatility traders and experts. But then there are some that really, I'm the nicest guy in the world, and I tend to be pretty rational. But there are some, as I've said in my trading room to our members privately, which of course you'll hear right now. But you don't want to say some of the stuff that you say to me on Twitter because you can get away with it. You don't want to say that to me in person. It won't go quite as, amicably, face to face. But
the other thing with online is just there's a lot of people that will come and attack you, and they won't even use their real name. They'll, it's like if you have such conviction, you and I, we're really putting it out there. People could, heaven forbid, look us up if they wanted to, and we're standing behind what we believe in. And it's we're taking a certain risk, but I think I speak for both of us when I say, we both have an interest in educating people that goes beyond, we're not making millions of bucks off of teaching people. It comes from a point. It comes from an area.
Not a business model, right, for sure.
it comes from an area of wanting, and liking teaching people about it and liking that light bulb going off in people's heads.
Exactly. I mean, this is not, something where, anybody is going to create a website and make, hundreds of thousands, if not millions of dollars off of subscription. It really is about building a community, teaching others how to better, invest and trade the market.
So here's a question. It says, worst and best trades of your career. And I know we're going to wrap it up soon, folks, because I've taken too much of Seth's time. But it says, worst and best trades of your career. Do you have any memorable trades that stick out to you?
Yeah, the worst one of my career. It wasn't terrible so far as, the loss. It wasn't terrible. It was just terrible timing and learning that just because management teams say XYZ doesn't mean they even understand the totality of their business. So my worst one was Whole Foods Market. I had bought at what would have been 25% off of the all-time highs, thinking this is a company that is doing really well. They have a long, stretch of runway to grow the business for years to come. And if I simply do an extrapolation of the revenues, if they grow to 1,200 stores, which is what Whole Foods management was, preaching over the next decade, I just do back of the envelope math. I'm looking at a share price, well above where I had paid. Unfortunately, within the next 12 months, it was discovered that there's not the capability of 1,200 Whole Foods Market stores across the United States, if not North America altogether. Why? Because price points. Kind of goes back to what we talked about with Tesla. Price points, your market is that much smaller. You don't have access to everybody who needs groceries at $10 a jar of peanut butter, just because it's organic. You have a much smaller total addressable market. There are only so many communities.
It's like a boutique or...
Right. It's like Lululemon. People look at Lululemon's share price and they're like, oh my gosh. But even Lululemon has realized that they can only expand so far. There's only so many, cities and communities in the United States that can hold an audience for that kind of a price point and grow and consistently, build revenue. So I was down a good 30% as this became understood that no longer, was this 1,200 stores across North America going to be the eventuality. And this was at a time where they had just over 425 stores, right? So, I was down 30% in the shares, did a couple of trades to minimize, cost average, got down to 25%. Nothing was changing. And they were just continuing to every store they would open, they would cannibalize stores, within a store within 25 square miles of the new store. And it was just solidifying the point that, they were saturated. They had saturated. Could they find new? Yeah, but still, that's not incremental growth, finding one more store that wouldn't, cannibalize an existing store out of this state. So I realized this, I had to get rid of this investment. This just wasn't going to work out. Management didn't know their own reach. And so I sold the shares. I got it, down to about 14%, and sold the shares literally 2 weeks later. And everybody knows what I'm going to say.
Of course.
Yeah.
Right.
Amazon comes out and decides that they're going to acquire Whole Foods.
They took it over. Yeah.
So that is like the worst, investment that I ever made. The best one, probably because I've spent so much time in it, was SodaStream. I got the IPO at $20 a share. Through my my banking relationships, I was given the IPO at $20 a share. Share price rocketed within the next couple of months to over $60 a share. And I was so fascinated by the business, I decided to pick up coverage of it as an analyst.
Now, were you limited as to when you could get out? Did you have to wait a certain period till you could get out?
I had to wait till the lockup. Yeah.
Okay.
So I didn't get out at $60. I just held on. It was free.
Yeah.
So I just held on to it, and I decided I wanted to learn more about the business. Within about 6 months of doing all my research and whatnot, I was the axe. I was the one that everybody came to. This was when I was, running a Capital Ladder advisory group. I was the axe. I was the top analyst that SodaStream actually told hedge funds to go to get my research. That's how embedded into the understanding of that business model I became.
Now, did you have to reveal that you own shares as an analyst on the thing?
Yeah.
It reminds me of that whole period way back when there was like major conflict of interest between analysts and companies. I just wanted to get your take really quickly on when we're talking about big losers, the MJ industry, the cannabis. I hesitate to say it on YouTube, and then I'm going to get banned again or something for talking about drugs, but the industry is just, I can just imagine all the stoners out there who turned to become stock market guys and bought these things and just got crushed in this industry.
Right. And this was what I was talking about 2 years ago. This is exactly when it became in 2018, the pot stocks, quote unquote pot stocks, just, everybody and their mother was IPOing. If you had a shop with a label on the door selling, medical, cannabis, medical marijuana, if not just retailing, in the legalized states, you IPO'd. And what I think, no, what I know most people didn't realize is like 75% of these new businesses related to the cannabis industry, they lose their license within the first 6 months of operation. You know how much it costs just to get those licenses to operate? And then you have to hire a consultant to basically, keep your license, keep you in standing to sustain the license and not, lose it once again. You essentially have a full-time on board, employee just to keep your license, just to maintain it. And that's the problem with a lot of these companies is they, all of a sudden you can sell this product. You've built this retail, business, and you lose your license because you're not aware. You're not aware of the regulations that you need to follow to keep it. Storage, transport, financing, et cetera, because it's still difficult, to do your banking as a cannabis operator.
Yeah,
And
it's like with 2020 hindsight, there's so many headwinds. Also, like the more efficient you are, the lower the price becomes for that you can sell it for. It's really just a commodity in the end. I mean, it's just there's all these terrible things about it, but it was so hyped and it sounded so cool. Like I made my money trading pot legally. Everybody wanted to jump in there, and people got just destroyed.
I was getting calls by some of these IPO companies because they read my works on Seeking Alpha and Talk Markets, and I mean, for those of you who've read my research reports, I mean, forget about it. We don't leave holes. Like we knew this correction was going, this drop in the market was going to happen. I don't leave holes in my research. It's that detailed. It's that in depth. And some of these, new IPOs in the cannabis industry would contact my company and ask if I would do paid for research, basically write up a research report that they can promote to the investor community.
Right.
And I was, I turned them all down simply because A, I've got too much on my plate as it is, and B, because your
reputation to go down the drain with these companies.
I don't believe in doing that kind of work. I think it's disingenuous. So,
yeah, it's. I do you think the industry has a chance of turn? I mean, obviously, has a chance of turning around. But what do you? Yeah. I know it's out of your wheelhouse, sort of. I know, but
no, it just needs to consolidate. Okay. You need the big players to come in
a little bit.
It's all going to come down to, I think, financial regulations around the cannabis industry. Once those become more broad-based and not selected to states, you're going to see the likes of Microsoft, which is already a big player in the cannabis industry. You're going to see these bigger conglomerates come in and basically set up a new revenue stream in the retailing of cannabis industry. But it's not until the financial deregulation is more broad-based, it encompasses all 50 states. Until that happens, it's just going to be this dog-eat-dog world in that industry, which is, it's not one that's finding respect. But it will happen. And I think that's the big thing that all of these folks missed over the last, and what Tim Seymour on, CNBC misses is, until that, headwind is removed, you're not going to have your epiphanic moment in the market for the cannabis ETFs, if you will, because everybody knows. Everybody knows that. Yeah.
It's like I feel like I missed the boat because I was a big stoner in college and stuff like that, and then I was all like Bob Marley legalize, Peter Tosh legalize it, all this stuff, and my cannabis career ended several years before it was legalized, and as I can say we won the war, but I no longer am interested in the product now, so I just kind of timed it wrong, I guess. But anyway. Do they still have pill mills down there in Florida for these opiate pills? Is that stuff still going on down there near you?
I hate to admit it, but yeah. I mean, all they do is basically, if they feel like they're going to be shut down, they shut down and reopen somewhere else, 10 miles, 15 miles, out of the way. And then people don't realize it's such a shadow industry, but the sad part is you have so much cooperation to keep it going because there's so many jobs that are created. And because it's such a big cash business,
Florida's economy. Yeah. I mean,
right. I mean, everybody loves, the cash that flows through these pillbox, mom and pop shops.
because I was trading Insys, and the CEO of Insys famously, went to jail. Actually, was convicted and sentenced, and I was trading Malincroft, which has kind of come around a little bit. I mean, this hit a lot of big companies. It seems like most of the waves of litigation against the opiate crisis have kind of come and gone. But yeah, I remember that being pill mills in Florida. Yeah, it's a big problem still in Massachusetts here too.
Yeah, I mean, I'm a spiritual person. I'm at church every Sunday. I do youth ministry every Wednesday night, and it's sad here in Florida. It's sad. We're constantly, at the church. We have newcomers that are trying to find their way. They live in a shelter, in their city or whatnot. Here in Ocala, they're homeless, or they're just out of rehab, and just so many. I'm glad that they're trying to find a better path through religion or a relationship of some sort with God and what have you. But it's rough here in Florida. We still have this it's just they come from different states because they're familiar with the packaging label that they're bought. They live in Kentucky, they live in the Appalachians, where the opioid crisis is just rampant, but they see the label on the package. It comes from Florida, and for some reason they wind up down here, either trying to get closer and then finally getting to a point where they've got to find help, and they're stuck here in Florida. So
totally. Yeah, well, it's something we're gonna solve this moment. But anyways, listen, thanks so much for coming on and talking to everybody. I've had a blast.
Thank you, Dave. Absolutely.
And it's always fun to catch up with you. I might actually be in Florida at some time in the next few months, so I'll definitely look you up if I come down. Yeah. Awesome. Well, thanks for coming on. Thank you for watching all the viewers that came on today. And everybody else out there, best of luck. Go and sign up on phenomgroup.com. I'm a member there. They filter out some of the riffraff, and great stuff going on over there at Phenom Group, and a great record, as Seth talked about. So thanks to Seth. Thanks most of all to all the viewers for watching today, and we'll see you next time on the Short Vol Show Live. Sound good? Thank you. All right. Stay with me for 1 sec, Seth. I'm going to cut the thing right now.
Okay.